Gold's surge to all-time highs this week has been relentless, with gold hitting a high of 21.95 in the New York session before closing at 21.86, another new all-time high. Well, what's next for gold? In this gold market commentary for Friday, March 8th, 2024, we'll get under the hood of this rally. We'll do a little bit of a gold tutorial, and we'll also go over what's driving the gold price to new all-time highs and what we think will happen in the coming couple of weeks. Let me share my screen and we will get into our update. In this gold market commentary, gold's record run continues. The Fed increasingly is leaning into talk of easing. We got the February jobs report this morning and it beat expectations, but so do the revisions. We'll go over the latest charts for the dollar, yields, gold and silver, and we'll also go over vintage US $20 gold coin premiums, which have been compressed by this gold bullion rally. Let's take a look at the latest gold chart. Here it is off to the right. You can see gold's relentless run higher from about 2030 all the way to just under 2,200 today. $170 gain over the last 7 trading sessions, which is a really strong rally. This is a big move. So what's driving this higher gold price? Well, primarily, the Fed has been talking about easing this week, with Jerome Powell testifying before Congress. On Wednesday, in front of the House Financial Services Committee, Chair Powell said the Fed is on a good path to achieving its 2% inflation target, with interest rates probably at their peak. Testifying before the Senate Banking Committee on Thursday, Chairman Powell said the Fed is not far from having the confidence in falling inflation to begin cutting interest rates. Well, what's giving him that confidence, or what's making him concerned? Well, today's jobs report came out for February, and the print was for 275,000 new jobs, which beat expectations of 200,000 by 75,000 jobs, a considerable margin. But what we've also seen is a very significant revision of the last 2 months. December's job print of 339,000 jobs was reduced 43,000 to 290,000 today. And January's whopping 353,000 jobs print was reduced fully by a third. 124,000 jobs down to 229,000 jobs. So there's a couple things I'd like to talk about here. Number one, we've seen a lower revision, and I believe every single month for at least the last 12 months after the initial print. And these revisions, especially for the January print, are significant. Number one. So we'll see if this 275,000 jobs print for February sticks when they look at this under the hood in the next month or two. So there's 2 months possibly for revisions. The second thing to look at is the number of jobs overall in the bar chart on the top here. And as you'll see, the average number of jobs over the last 12 months is coming in between 225,000 and 275,000 jobs pretty consistently. In my opinion, the break-even rate for job creation to keep the economy moving forward is about 250,000 jobs. That's the stall speed above which or below which the economy really is expanding or contracting. And jobs are what matter the most, because the consumer is our economy. 70% of our economy is consumer spending. We've talked about that before. But what's also happening now is we're seeing the unemployment rate tick up from a low of about 3.4, 3.5% a year ago, was 3.7% last month, and now it's 3.9%. So the unemployment rate is becoming more significant. And that was on ex-Fed Governor Bullard's mind today following the February jobs report. He said it increases the chance of the Fed cutting rates sooner, and specifically because of the rising unemployment rate to 3.9%. According to Bullard, that will get some people's attention. It's the highest unemployment rate in just over 2 years. So we might be seeing the U.S. economy continue to soften a little bit here. We'll see. So how is this affecting the futures market for where the Fed rate will be this year? Numbers in yellow are all up about 1% in the last week, and the numbers in purple are down 1%. So we've seen some very modest parsing of this information, with the market betting that the June meeting, not the March meeting, which is just in 2 weeks, or the May meeting potentially having a rate cut. But the markets are really betting that we're going to get a rate cut in June and July. And by September, the Fed funds rate will be between, almost everyone's betting that the rate will be between 5% and 4.5%. At that point in time, it'll probably be either 4.75% or 4.5% before the election. That'll be the last real meeting where the Fed can actually do something. And they may not want to do something in September because we will be in the presidential election cycle then. Now let's look at what's happening with Treasury yields. Well, they continue to slough off. This is a 1-year Treasury yield chart that shows off to the right. You can see the 2-year in purple and the 10-year in red continue to skid a little bit lower. Now, these aren't big moves, but this is, again, the biggest market in the world, the US Fed Treasury market. This is a pretty significant trend change that we've seen over the last month, 5 weeks, and it's ramping up a bit as well, especially with the 10-year yield. Of course, on the top, you can see the Fed funds rate in black holding steady at 5.25% to 5.5%. Let's look at the dollar. The dollar has taken a tumble this week, falling almost a full point on the US dollar index chart, down from about 103.75 a week ago to 102.75 today, and it's approaching support at 102.50 in the short term. So we'll have to see how that goes, but I think the dollar will probably continue to skid a little bit if the markets really believe that the Fed will be cutting interest rates perhaps sooner rather than later. Now let's drill down on gold. Again, here is a 1-year gold chart. And this chart, which we have traditionally used for years, is the New York market close chart. This chart simply shows where the New York market closed on a daily basis. It doesn't show any of the intraday trading. You can see the previous high on the market close for New York was 2093, basically a double top that we've pierced through now sharply from about 230 all the way to almost 2200 today. Let's drill down a little bit on gold on a more intricate or more detailed daily basis. This is what we call a candlestick chart. Now, candlesticks measure the open, the high, the low, and the close. The body of the candlestick is the open and the close, and the stick or above or below the candle itself, the wick, is the high and the low. If the candle is black, that means the market went up that day. If the candle is red, that means the market went down that day. So as you can see, the previous New York close was 2093. But actually, when the market closed at 2089 in late December, we had a really wild Asian opening on a Sunday night. I remember this vividly, watching the futures market as the gold price traded all the way up to 2152 before the New York market opened, and profit takers came in and hammered the price way back down to about 2075. But that technically is the previous market top, which to this week's rally has now broken through fully. So when we said last week that we thought gold could run as high as 2150, this is why. That's where that candle took the market to. Now, if you look all the way over to the left of that little circle, that was previous market resistance on short-term candlestick intraday high, which the market off to the right couldn't really pierce except for that one wild Sunday evening session in Asia until now. And this is where resistance can become support. And that's important for you to remember. Let's drill down a little bit tighter on this and go to a 6-month candlestick chart. Now you can see the last big rally we had in gold was in October of last year, when gold had gotten down to about 1820, and then Israel was attacked by Hamas, and gold caught a bid. And at that point in time, it ran up to about 2020 intraday. And as you can see, those candlesticks are mostly black on the way up, but then they get to the top and the wicks start to stick up, and then they turn red as profit taking kicked in. And now off to the right, you can see we've got a similar situation where we've got a real sharp rally. with nothing but black candlesticks going up and no red. But we've also, at the very right, we've got that black wick where today's market action took the price higher, but the close was actually substantially below the market peak intraday. This shows that this market is starting to lose a little bit of steam. It also shows us where the support will be should we get into a profit-taking situation. The first level of support will be at about 2150, and the second level of support will be at about 2100 or 2098. And let's take a look at one more chart, and you can see how resistance becomes support. Over to the left of the chart, that big horizontal line in red turns green when the market moves over it. And I expect to see the same thing in the current market off to the right as time passes. So we'll see support at 2100, which will be major support, and then short-term support at 2150. And I do think that this gold rally is due for a little bit of a pullback. And I don't expect us to continue to see the really strong momentum we've seen over the last 7 trading sessions, which has really been sharp. I do expect some profit taking to kick in. It's anyone's guess what could happen next. So who knows? But this is what I suspect will happen in the marketplace. So I do expect that gold is getting a bit toppy here. We should see some modest profit taking over the next week. Maybe not. It's anyone's guess. But this is an educated guess on my part based on a long time watching these markets and being a chartist. Here's a chart for silver. As you can see, silver is still lagging gold, but it has played some catch up. It's up about $2 from 7 days ago, from about 22.50 to 24.50. It still hasn't broken over major short-term resistance at $25. It did break over resistance at 23.50, which is good. I expect to see the market, if we get into a little bit of a profit-taking situation, try and hold that 23.50 line as a support level. But silver continues to lag gold, which is leading. Gold's at an all-time high, and silver continues to be less than half of its 2 previous all-time highs. Now let's look at one other chart, which is a chart for the premium and price for US $20 gold Saint-Gaudens vintage $20 gold coins in near gem choice uncirculated MS64 condition. The important line on this chart is the pink line, which is the premium or the amount of value over intrinsic metal content that these coins are trading for. And as you can see, for the last 5 years, the premium's been anywhere from about 13% to a little over 40%. And specifically, 13% in March of 2020 when COVID erupted, and we saw a similar gold surge, and then the coins lagged for a while. The premium got pushed down to all-time lows of about 13%. But following that, when gold stayed up and the coins played catch-up, we saw that premium get to about 35%, and the price go from about 1650 all the way to 2500. Now off to the right, you can see the rising gold price, and the lagging price for the $20 gold coins has pushed the premium back down to record lows at around 13%. So these coins are not reacting to the gold bullion run as much as we would like them to, but that's creating opportunity for buyers who are patient. Twice in the last year, the premium for these coins has been at 40% over gold. So when you can get a gold play and a premium play, we love these coins. And right now, the premium's at an all-time low of about 13%. So this is a good bullion alternative to consider. We call it bullion with muscle. So that's our update. This is how you contact us. We're a national precious metals and vintage mail order company out of Austin, Texas. We'd like to help you in this market in any way we can. We're consultative in nature. This is our 25th year in business. And we always remember that without our clients, we wouldn't have a business. So thank you for your support. If there's any way we can help you, whether you're buying or selling, we'd love to have that opportunity. If you happen to like what we're doing, please like this video and please subscribe to our YouTube channel. Thank you so much for your time today, and have a good day.